Hey everyone, it's Mike and welcome back to the Orderflows Absorption course, Module 6, Absorption Trade Setups. Now before we begin, a brief disclaimer. This presentation is for educational and informational purposes only. It should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Alright, so the 6 setups I'll discuss here is setup number 1, the dead cat bounce. Setup number 2, irrational exuberance. Setup number 3, capitulation. Setup 4, price exhaustion reversals. Setup 5 is absorption pullbacks. And setup 6 is absorption breakouts. Okay, so the first setup is what I call the dead cat bounce, and it occurs in downtrend when buyers appear at a low. The price rallies a little, goes sideways, and selling reappears, and the market continues lower to new lows. The outlook for the market is still terrible. At a high, people don't refer to it as an inverted dead cat bounce, but it can happen at a high, and when it does, it's aggressive sellers appear at the high, prices fall off, then goes sideways, and aggressive buying reappears. The market makes new highs. Now this is a trade set up for continuation. Now we've all heard that, we've all watched TV and we've all heard commentators say, oh, this is a dead cat bounce, and they're expecting the market to go lower. Now what I find as being the telltale sign of this type of move is stacked buying imbalances appearing just before the new high is taken out, stacked selling imbalances appearing just before the low is taken out, and the market has already made a new high or low, so it's coming back, right? It already made the high. It starts bouncing up a little bit, and then you see another round of selling. So made a new high or low, established, and circles back to that. Circles back to test it. Now you don't always get those imbalances, stacked selling imbalances or stacked buying imbalances, but when you do, I like to watch how the market comes into the low. So the key is the pause after the low is made. It could be profit taken, as it could be the long-term traders not wanting to overpay if it's going to a high. As a trader, you don't know what the reason is. And, when I say, it could be profit taking, imagine a market that's been selling off here, right? It's been selling off. Everyone's been short. We hit a low, we bounce a little bit. People that were selling are taking some profits here. Okay, they're lightening it up. And then another round of selling comes in and the market sells off again. So for this type of setup, it's really, you have to apply what you know about order flow, right? It's not just an automatic setup that you can just tell right away that, oh, this is a dead cat bounce and you could get short right up here at the high. You don't know, right? You don't know. So what I'm looking at is I see the market coming down. It's coming down on decent volume, starts going sideways. I do have this bearish point of control right up here near the top of this bar, which is a bearish sign. Obviously you still got the positive delta, but it's a red candle, so that's also a bearish sign. Then I start coming into this low down here. Okay, I see one selling imbalance. Now granted, it's a 5-minute chart. You don't get a lot of imbalances all the time on a 5-minute chart because there's a lot of trade going on over that 5-minute period. As you start coming into the low, I notice how we take out this low. You also have this imbalance. Now, there's probably some other imbalances as this market's trading. This one's stuck. You finish that bar. You got 1, 2, 3, 4 imbalances. Now, would I like to have some sort of other sign, like a big stacked imbalance in here? Yeah, but like I said, you don't always get what you want in the markets. But based on what I'm looking on this bar, okay, I know that's bearish. I have this inside bar, which is also, I'm waiting to see how this market reacts. This is a sign that the market's pausing. You have the inside bar. Got this bearish bar here. I know I'm coming down into this low. If I wait until this bar closes, I really have the confirmation. People say, well, you're waiting for the bar to close. You're giving up an extra 2 points. Well, yeah, if, the trade is not here necessarily, you don't have full confirmation until this bar is closed. You have a bit of confirmation here earlier in this bar at 10:05. Once this bar is closed, yeah, you could feel fairly confident that there's more to this move. Okay, so here you got your first bounce here, heavy volume. You got your inside bar, takes out this low. Yeah, okay, honestly, I'm not convinced that this is really a dead cat bounce in this one bar, just because you have one inside bar. But when you get down here to this low, you do rally up. I mean, you do have this divergence. You got this nice little rally, okay? And you're thinking, well, this is it. This is our rally up to new highs. But if you start watching, keep your eye on what's happening in here. Yeah, you have the strong delta here. These 3 bars, kind of bullish. But then it goes sideways in here. Then boom, you get the big selling comes in again. The stacked, or sorry, the multiple imbalances in here. You're starting getting the lower point of controls. Then watch as you get down towards the low. What's happening? Do you have, price exhaustion or what? Instead, you got that stacked imbalance going right into the low, and you take out those lows and make new lows, go sideways, make new lows. Now, the dead cat bounce is not something that you're just looking for the quick hit. It's going to take a while. It's got to circle around, comes in, takes the lows. Now, you got to remember, right, when you're trading breakouts, you don't always just take out the low and immediately go low, 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 low. You take out the low, you might bounce around, go sideways, bounce up a little bit, take out the low, go sideways, bounce up a little bit, take out the low. So if you're trading with, a very tight stop, say you have, your entry down here at 58.60, you can't have a stop here at 58.65, a 5-tick stop, because you're going to get pullbacks, right? You got to remember, the market's been dropping. People cover their shorts, market starts to rally a little bit. It looks like it might start rallying higher, and then it circles around and comes back down. So you got to manage the trade. Look for signs in the order flow, right? This is wouldn't be getting short on this bar here or this bar. This is what I'm looking for on the bounce. You got to get a bounce first, but then you get your trade opportunity. So you're coming down in here, low, 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 low. You hit this low. You got the inside bar, sign of sideways activity. Start going sideways, sideways, sideways. Then you get this bar, right? The low is here. You get this bar, 1 tick off the low. Selling imbalance, selling imbalance, selling imbalance. Multiple imbalances in the bar. Remember, I treat multiple imbalances, 3 or more imbalances in a bar the same I would a stacked imbalance. That's why I have this box drawn. That's why I use my software and I have the box drawn around the bar to tell me there's multiple imbalances. You take out the low right here in this bar. You trade lower by a few, 3 ticks, 4 ticks, and then you go sideways, you bounce up a little bit, and then you get to push down again. So, as you get the breakout, but then it goes sideways, it circles around, and then takes out the low again. You're bouncing here, right? People are looking for a low, but the selling is not done yet. But overall, the outlook for the market is still negative. So here, right, you get the big push down. This is gold. You get the big range expansion bar here. Multiple imbalances near the top. You hit this low, positive delta. You start going sideways. Then you come in here. You hit this low. Right as you hit the low, you get that stacked selling imbalance in there, and you make new lows. Now, where would you be looking to get short? Well, as soon as you see a stack selling imbalance, do you have to wait for this bar to close? Well, you can, and you get a little bit more out of the trade. It does make a new low and make a new low. I mean, that's the problem if you're trading breakouts sometimes. You may get a breakout, but it's not like a breakout that's going to become some massive runner, right? Because when you hit a dead cat bounce, people are already looking for lows, right? They're looking to position themselves to possibly get long. So sometimes there's not a big capacity to get low. So how can you trade it? Well, you can trade a pull back up if it bounces up again, or you got your trigger, you got your stack selling imbalance. You should be watching what happens when you take out the low. I mean, there's different ways to trade it, right? You could get short right after the new low is made, or most conservatively, you got to wait for the low to be made. But I don't like that. I think when you're trading breakouts, you got to be a little bit more aggressive than conservative. Like I said, you did get a further breakdown over the next over the next bar over several ticks, but technically, yeah, you got the breakout, but it didn't really go anywhere. Or you could play a pullback up towards where the previous low was, right? Because previous support becomes resistance. So that's going to give you a low risk entry. And then you manage your trade from there, right? You have a trade plan in place. I know a lot of people, they discount the simple stuff in life, but previous support becomes resistance. Previous lows, is when you test back up to it, is going to become your resistance, just as previous highs become your support. So you get the big down bar here and the new low. Get your inside bar, start going sideways. Get the push here. You already got 1, 2, 3, 4 imbalances before you even hit the low. Take out the low, and you just go lower. So for me, one of the triggers on a dead cat bounce is I'm always looking for an inside bar, right? Sometimes you get them. Sometimes they look like this, though. This is not an inside bar where you just take out the previous low by a tick or two. This one is like 2 or 3 ticks, but as long as majority is in there, usually it's a lot neater, like this type of inside bar, like this type of inside bar. But I'm really looking for that because that's I need a sign that the market is going to go sideways for a little while to get a bounce back to test that low again. Now, here's one. Okay, you're coming into the low. You got the stacks down and balance in here, and you just blow right through the low. Again, if you had to stop somewhere down here near this low, okay. Now I wouldn't consider this type of bar here a trigger for a dead cat bounce. Can you take a trade here? Yeah, you can if you're a breakout trader. This bar wouldn't be the dead cat bounce trigger bar. Let me rephrase that. This bar would not be the bar that, this is the down bar that you got to look to for, I'd be looking for the dead cat bounce. This bar should be lower here, basically, is what I'm saying. When it's up here like this, it's, even though you did come back down and take off the low by 2 ticks, this is not what the type that you're looking for. The market has already rejected these lows in this bar, actually, and is already starting to rally. You start coming back down here. This bar, if this bar took out the low, and closed down here, then you get this inside bar. And this inside bar was, closer to the low than closer to the high. I'd possibly be looking for a dead cat bounce, but this is not what a dead cat bounce looks like at all. So don't try to see too much into them. Like I said, look for this inside bar here, right? Look for this inside bar here. That's for me the sign. After you get that big push down into the new lows, look for an inside bar right after. To me, that's the sign. That's the sign that you should be looking for. Now, I didn't put dead cat bounce at the high because you don't refer to dead cat bounces at highs. But it would be the opposite of what you're seeing at a low. Now, the setup number 2 is actually more of what I consider a dead cat bounce at a high. It's sort of the opposite of 2 things. One, capitulation, which I'm going to talk as the next one, and the dead cat bounce. But anyway, irrational exuberance. For those of you that are old enough to remember back in the 90s, gosh, I think it was 96, Alan Greenspan was giving a speech on December 4th. I think it was December 4th, but it's funny because I remember it was the speech I came into, and it was fucking going nuts in there. It was, everyone was selling everything, and I'm like, what happened? Like, oh, Greenspan gave a speech. I'm like, yeah, so what? And he said, the term they said was the market's got irrational exuberance, meaning it was overpriced. He said, what did he say? He says something to the effect that irrational exuberance had escalated asset values, and the market just got hit. All the Asian markets, Globex, S&Ps sold off massively, and this is when S&Ps are still trading 400. So you're down we hit limit, I believe, overnight. And then when Europe opened up, no one knew what happened, honestly, in Europe, because they just sort of woke up, and all of a sudden the markets are down, slammed, and everyone is not panicking, but everyone is like, what's going on? And when you don't know, sometimes you just sell. But what happens is it occurs after a sharp rise in market price attracts hot money to the market, week long, so to speak, which causes the market to rise even based further on nothing special. But think of Bitcoin, okay? FOMO, fear of missing out. When you had that big run up in Bitcoin to almost 20,000, people describe that as irrational exuberance, right? And once traders realize we're in an exuberant market, traders come back to reality, the decline is very, very dramatic. Exuberant rallies are difficult to sustain because the value of what's being traded is so far out of line with reality. It's almost like, Beanie Babies. You could think of all these bubbles, right? When people think of bubbles, they think of the term irrational exuberance. Now, the opposite of exuberance is capitulation. Fear is overtaking greed, and traders cannot withstand any more pain. They just want to get out. Sometimes you can go from irrational exuberance to capitulation very quickly, and capitulation is the third setup. So when you have capitulation, everyone just wants to get out. Their loss is blown beyond their expectation, right? We've all probably been there. I'll admit it. I've had to capitulate on trades. I had the sugar trade years ago, back, I think it was 2010. I knew sugar was going to go up, and I had bought it, and it didn't go up. It just went sideways. It went up like initially the first day after I bought it. And I was telling all my trader friends that this is it. We're going to go from, we're going to rally, we're going to double or triple in price. Eventually, it did work out, but initially it didn't. And it just took a lot of heat, and eventually I had to sell. And, to me that's capitulation. We hold on to a trade too long, and then we got to get out. And the institutional traders wait for this moment to either go long or cover their shorts, because obviously institutional traders oftentimes are the ones that are on the other side of the retail traders. Basically, the herd or crowd is the last to act, right? This is a reversal setup. So with irrational exuberance, when the buying starts to dissipate and the herd buying becomes exhausted, there's no more buying to move the markets higher, as the bigger players have been distributing their supply on the move up, right? Other aggressive sellers start coming into the market and hitting bids. And I remember what I was telling you, right? When your market is rallying, you have the institutional players often selling into those rallies, right? And then, they don't necessarily just come in immediately and start selling. They don't just all of a sudden wake up, alert on the top of the computer starts flashing saying, oh, red alert, we're overpriced. We're outside of value so much, sell. It's not like that. But, for the bigger short-term traders, they realize that, and they start pushing it down. That's where this is where recognizing the big short-term traders comes into effect. So rational exuberance, right? It will look like this, right? You got the big up bar followed by the big down bar. But you notice on the big up bar, right, you got the buying imbalances, you got the heavy volume, the very big positive delta. But then immediately next bar, selling imbalances, multiple selling imbalances, the big negative delta, the big red bar. Now, would I like to see it close lower than the previous bar? Yeah, that's nice. It doesn't have to. But really sort of what you're looking for is this flip in what's going on. Right? Notice the max delta 4337, min delta minus 21. Close at 3,269 here. You got min delta minus 5747, max delta 31, and we closed the delta at 5722, minus 5722. So it went from all aggressive buying to all aggressive selling in terms of delta, and we closed lower, right? Everyone was buying. Oh, we're going on new highs. Oh, wait, whoops. I'm sorry. I shouldn't have hit the buy button. I should be short. And then come in and everything sells off. Here it is again, right? You want it to happen on very good volume, ideally. Now here you don't have the, the stack selling imbalances. You have the stack buying imbalances going into the high, everyone is excited at these prices, right? It's nice to get the stacked selling imbalances or multiple selling imbalances in the red bar. You don't necessarily have to. That's not a killer, a trade killer if it doesn't appear. As long as you got a nice strong negative delta, that's important. And volume, it should be decent. 14,000 here, outside the big up buying here, 20,000, you're getting bars in here, 14,000. It's a little bit less than average. 16,000, 19,000, 15,000, 17,000. So it's decent. It's not the end of the world. It's not such a small number. It's not like 8,000. It's still healthy. But you're looking for basically that reversal, right? If you were to break this bar down like this here, right? This is the delta bar, right? This is the same chart here, okay? So I talk about having a different chart, an additional chart up to help you see these things. Here, look at this high. It's mostly all aggressive buying, right? You got one here, 109, 45, 21. And then this bar, the red bar, all sell, other than the top two bids here, or top two offers that traded here, everything is hitting the bid, everything, every price level here. So it's like the mirror opposite of the big bar up. Now you have this bar here, but people say, well, don't you have it here? Well, this bars, you do have this counter trade down in here, down in here, down in here, and up here. It's a little bit more evenly split, whereas up here is really slanted to one side. People say, well, what about this one? Well, this bar market's already coming off here, right? You're ending up almost as a doji in this bar, which is already a sign of a reverse potentially happening. You get this bar is kind of mixed. You got some selling up near the top, some selling up down near the bottom. So it's a mixed bar. Then you just start going sideways again. Then you get that big push up, the last big push up. And then people say, nope, sell it back down. Okay, so this is also a delta chart. This is a different market. This is crude oil. And again, what you're looking for is a bar like this, right? The big delta up, big volume up, 9,000. And then people come in and say, wait, big delta down, minus 792. Do you have any delta, any positive delta stronger than that? No, you don't. You even got the stack buying imbalance in here. You can't see it this price level, but on the order flow, on the underlying order flow chart, there's a stack buying imbalance there. That's why you have this green going across. Volume is decent. It's not 9,000 that you did earlier, but you got 6690, which is still strong for what you're looking at before. And majority of this, everything is on the bids here. You do have a little bit of counter trade, but again, big delta up, positive delta up, followed by stronger positive delta down, and then the market goes sideways before it eventually falls down, falls over. Again, this is similar here. You get that big bar up, the big volume bar up here, 16,000 volume. You hit this bar, closes right on the high, opens up a new bar, trades a couple ticks higher, get the big selling coming in here. Now this bar, I'd look at it and say, yeah, maybe, you do have a divergence, you do have a little bit of counter trade, and you might not be convinced yet. It doesn't have to be that you get the big up bar, you got to have the big down bar. If you were to merge these two bars together, right, this bar and this bar, all of a sudden it's going to look like this. People sometimes don't think in that respect that, well, let's look at it over the next two bars, right? Take them together, and you're going to have this big down bar with mostly hitting the bid. And look at this volume, this delta, minus 1066. So when you're not convinced on this bar here, you wait for the next bar for further confirmation that, yeah, okay, I'm leaning towards short on this bar, but once this bar comes in, then you should be convinced. That's the thought process that you have to go through. Go through it. Don't say, well, this one didn't. This bar only got 422. Doesn't meet my expectations so I'm not going to take the trade. But then when you start seeing, well, the next bar, well, it had even stronger negative delta, twice as much on basically the same volume, so I know that the sellers have appeared. You could get short. Where's your risk? If you're getting short, somewhere in here in this next bar around 50, where's your stop? It's somewhere up in here, at 65 towards the high of this bar. Because if we're going to start going higher, you don't want to be short. So, if you're getting short somewhere around 50, you got to stop, maybe around 60, 65. That's what, 15 ticks. But you're short at 50, down to where? Down to the 20s. It could go lower, which it did. But, that's how you got to think, right? Don't just limit yourself to, to this one thing. Say, it's got to be in here. It's got to be in here. And if it's not, then it's a failure. This one has a fail. Now, to me, this is the bar that sort of triggers the irrational exuberance. We're going higher. You've got, volume of 8,000. I don't consider this one here, even though you got a big strong delta of 725. The volume is just average. Here you get the big push up 8,000. Then you get the red bar coming in here, with the stack selling imbalances. Strong negative delta 644. I'll be looking for the market to sell off. It doesn't. It just goes sideways. You already got two bars. Market's going sideways. If you're short and the market's going sideways and starts going back up towards the high of these two bars here, that's not a good sign. It takes out that high, it fails. This bar up here, you're high because volumes jump because cash just opened. So obviously you're putting in some relatively small volumes. All of a sudden you're looking at 11,000. When I say cash, I'm talking about the cash of equities, because this is crude oil. But during those certain times of days, you got to realize when you're going to get some sort of volume pushes. And people nowadays work all sorts of exotic products. This market against that market. So if people are working S&Ps against crude, and people do these weird things, combinations now, these weird spreads. So I'm not surprised to see a volume push right up at 830. Now, again, this bar is already starting to come off. For irrational exuberance, the trigger bar should close higher, much higher. Like when I say higher, closer to the high, then rally up and then sell off like this, like here, right? We're closing right up here near our high, right on our high. But this one, it rallied up, then sold off. Then you get this bar here, which again is a bearish bar. I mean, you could make the argument, oh, you got some irrational exuberance here, but this is not how I would categorize it. Sometimes it's easy to say, yeah, this is it, but it doesn't necessarily meet the requirements I'm looking for, right? The green bar ideally should close higher, because now when you get a bar like this, you're already sort of looking at a reversal type of bar. Now this one, when I first put this up here, I was looking at this bar, and I say borderline because there's a lot of borderline. I don't have the heavy volume here, right? This small little high here, and then the next bar, it's an engulfing pattern. I'll say engulfing pattern, but it's an outside bar already, so it's already closing below the low, which already is a bearish sign. Then you get this bar right here, right? 15,000 contracts traded. But again, it's not the type where it closes up near its high, right? It's already sort of reversing, and then obviously you get the big down bar here. Again, on very heavy volume, big negative delta, but this is not really what I would consider irrational exuberance. I'd still want this bar to close up here at the high. This bar over here, 16,000 contracts, it closed up. This bar, strong negative delta, 3.6. You got a couple of selling imbalances out of this one, or these two here, or this two right here. I'd consider this one closer to irrational exuberance, but this isn't a high, right? This one, we're coming back up towards the high, and that's the problem. Then it sells off a little bit and just rallies back up and goes sideways. because you're already running into the close. Now, one thing to keep in mind is, people say, well, look at this volume, 61,000. Well, that's at 3 p.m. Chicago time, which is when the cash market closes. So you're going to get a lot of orders there. And honestly, depending on what the market is doing for the day, sometimes you're going to get a lot of big market on cash close orders, and people have these algos that start them early. And depending on how big the order is, they could start 15 minutes early, they could start a half hour early, because really what they're trying to do is target where it's going to close. Okay, so imagine, right? You're coming into the close. Oh, I got 5,000 E-minis to sell or 10,000 E-minis to sell. They'll start spreading it out. All right, imagine if they're selling it here, and we close. Where we close here? Like, I forgot which bar. This one. And they're selling on the way down because they know they're going to, their order's so big they're going to push the market down. So they start it early because they're really trying to target this price. So maybe their average price is a point better. And then the trader looks like a superstar. Now, this, would you consider this irrational exuberance? No. This is something else. You got your big up bar here, right? People say, oh, you got your big up bar. It just has a decent up bar here, but this one is more telling because the volume is much stronger, 24,000. Even though here, when you're looking at 15,000, you're thinking, well, it's 15,000. It's, it's much bigger than it was earlier. This bar, this red bar it should be more towards the inside, because what you're looking for is irrational exuberance after the green bar. Here market still runs up another 2 points, right? This is another type of short. This is a ratio and divergence, which to me is the bread and butter trade. I always talk about the ratio and divergence. Even the move from here to here is good, but to catch this type of move is, that's just icing on the cake. Now, again, irrational exuberance. This one, I have the question mark because, would you consider this irrational exuberance here, this high here? No. And then it's a bit drawn out here. Now, again, this is E-minis. This is, notice the time, it's 4 in the morning. You have this big run up here. Now this is a very bearish sign by itself. I would not consider this irrational exuberance because, even though you have, the big strong volume, 1600, it's not overwhelming. It's not like a hit you over the head type of volume. Back here you got 2,300, 2,400, 2,300. You got enough bullish information already in this bar. I wouldn't be looking to extrapolate this as saying, well, this is irrational exuberance. I've got extreme point of control here. I've got a ratio and divergence. To me, that's already the sign to get short. And then the market sold, immediately sold off. But even if you miss that, you did get a little bit of a pullback to catch more. But, can you get short here? Well, you have a divergence. You got a prominent point of control. But, I'd like to have a ratio as well. But this is the bread and butter trade. But I would not consider either of these necessarily irrational exuberance. Like I said, sometimes you want to see things in the market for whatever reason, but it's not really there. So, just be careful on what you're trying to describe. Okay, so that's setup number 3 is capitulation. It's the opposite of irrational exuberance. It's a reversal buy setup. And it's really easy to see on a chart. Big red bars, heavy volume, lots of selling imbalances, a strong negative delta. Near the end of capitulation, the market turns when sellers become exhausted, and the last seller is sold. Passive accumulation appears almost to arrest the market from dropping further. Now, the difference between capitulation and dead cat bounce is capitulation, the market's not going to drop further. This is where the drop ends. Okay, once traders think the bottom is formed due to signs of passive accumulation, the next phase is aggressive accumulation. And what makes capitulation such a juicy trading opportunity is it occurs when the herd is collectively wrong and get out. Right? The herd, the retail traders, the public, so to speak. And if you believe that the herd is always wrong, this is your prime opportunity to trade when they're most wrong. Right? Spotting capitulation early is key to a more successful trade. If you enter too late, you join the herd as they start buying back in, and you're competing with them for the offers. Right? Because if you come late to the party, you're not going to get a pretty girl. Capitulation and exhaustion occur at ends of moves, not in the beginning or middle. Oftentimes you see the market start moving in a direction, then it just really picks up steam and ends in capitulation or exhaustion, depending on the direction. It's usually punctuated with volume spike, which is indicative of FOMO, or fear of, that's actually not FOMO, fear of missing out, or fear of holding a losing position. I sort of combined capitulation and irrational exuberance on the same page there. But for capitulation, it's fear of holding a losing position. Capitulation has two unique characteristics: a sharp, almost vertical price drop, usually occurring over several consecutive down bars closing on their lows, right, with the heaviest recent volume with strong negative delta. Okay, we've all seen these big bars like this. Boom, close right on the low. Strong negative delta, strong volume. Boom. And here you don't have strong negative delta. You got strong volume. Here you got strong negative delta, strong volume. You get your inside bar. Notice it starts going sideways. Aggressive buying starts coming in. 600 positive delta, 340 positive delta. You're seeing the imbalances on the bars before the market starts taking off. Now, this is the bar I showed you earlier, right? When irrational exuberance, I'm saying this is not irrational exuberance. Now you get this capitulation here. This one's tricky. Honestly, it takes guts to buy after a bar like this. This is such a big bar, from 54 down to 41. For someone to come in here, I think that's gutsy. Me personally, I can't, I wouldn't do it. I said that's too much. But this is what capitulation looks like. Then you come back here with a decent, strong, positive delta. Even in here, you got buying imbalances in here. So you did cover back most of that move lower before you went lower or sideways to start drifting sideways to lower. But again, this is what it looks like. I prefer it to be a little bit more methodical than one big bar like this. I prefer it to happen, push lower, rather than wham, get everything down there. Really, that takes guts to stand there and buy it like that. Because you buy it like this and you get another bar like that down. Next thing you know, it's 10 points against you. I like a little bit more methodical activity in my trading. Like here, you got big bar down, another bar down. Okay, now I start seeing I'm starting to see the signs. Right, I'm starting to see the imbalances. I do have a divergence. I do got ratio, and I start feeling a little bit more safer on this buy back up. Right, if I'm buying in here in this next bar after this bar with the imbalances, where's my stop going to be, or where's the area I'm going to be looking that if we test to possibly get out, is where the point of control is on this bar. Right, you see how we came back down to within about 2 ticks of that point of control before moving back up. Okay, look at the volume on the green candle on the low, 9,000. It's a nice healthy volume. Now notice you got your capitulation here, then you just sort of go sideways, and then you get another big push down on, again, healthy volume. Now what's interesting is this big push here, 14,000. This big push here, 8,000. So it's 6,000 less. So it's like 40% less volume, which, going back again to the basic volume analysis, the volume on the big push lower to new lows is less than the earlier push low, which again is a sign that, well, less people are participating on this move down. Then you get the buyers coming in here. Even though it's a smallish delta, you got bigger volume than the previous one. So I know, you got a little bit sign of absorption going on in here. And the market starts going back up. Here is where you start seeing the aggressive buying coming in. So realistically, you'd be looking to get short somewhere in here. I wouldn't be getting short necessarily right off of this bar, but this bar here with the multiple imbalances is, to me, is the area to be getting long in, from the 25, 27 area, get up to into the 40s before you get a bearish sign in here. Crude oil. Pushing lower, strong negative deltas, 800, 925, 800, 424, 752. But then notice here, you get down in here, it's only 20. Then on here it's positive 70, right? Then 169. Now with capitulation, right? Like when I was talking about rational exuberance, right? I was looking for a bar, ideally, that's going to close somewhere, the high and the low are relatively evenly matched. With capitulation, I find oftentimes you tend to just overexert, right? Because the selling, markets sell off faster than they rally. And you sort of get this knee-jerk reaction. Everyone is selling, and then boom, it snaps back really quick. I'm willing to forgive, if you overshoot the low of the red bar a little bit, just because I know that, the way people react in selling is, they just got to get rid of it. Then I look for the aggressive buying. I look for obviously the first thing I want to look for is buying imbalances, but if I don't see it, I'll be watching the deltas. There's actually the delta surge here, but by this bar, positive delta 559, is telling me that, this low can hold. And I'll be looking for it to go higher, or it just goes sideways though. Okay, so here, let's take a look at this. So, this is where it gets tricky, with capitulation. People say, well, this is capitulation here. Like you see this red bar all hitting the bids, followed by all buying. This is the opposite of what I just showed you on FOMO. But with capitulation, this market it's working its way down, right? It's just working its way down slowly. Really, with capitulation, I like to see the sharp drop, right? Like this. Like not a market that's sort of working its way back down. I do like this, the way it looks on the chart, where it's all selling, they're basically all buying. You got the strong negative delta followed by the strong positive delta. This is a delta flip, actually. You got 0 to 0 here, all negative versus all positive. Obviously, you got an inside bar. It indicates market might go sideways a little bit, so I'd look for another sign. But this, I would not consider this capitulation, but I'd consider something else. But it's still a very bullish sign to look for. So it's a mirror image. I'd be looking for, if it's capitulation, I'd be looking for this bar to be a little bit higher, and I'd be looking for the sell-off to be more dramatic than that. This is it. This is the same thing right here. This is the this is the volume footprint chart. This is the delta chart. And again, I prefer it to be, a straight down price drop, dramatic. This is a market that's just sort of coming in for a landing, like an airplane coming in for a landing. Airplanes don't just drop at 45 degrees in for a landing. They sort of just glide right in before taking off. It's bullish. It is bullish. I'll give it that much, just based off of what you're seeing in here with the deltas. But I wouldn't consider that necessarily capitulation. It's not like, I'm just taking too much heat. We get a bounce up, come back down. I can't take it anymore. Then you get that push. I take it. Look for this. If it was real capitulation, maybe this bar would be bigger. Now, I just threw this in there because, like I said, there's certain days, you don't want to be trading. Would you consider this capitulation or this capitulation? Well, honestly, I wouldn't be looking to trade on a Fed day. Here you got the big down bar, big strong negative delta, and here is followed by the positive delta. Market just goes sideways, and you get the other push down here. Do I consider this capitulation? No, I don't necessarily see the aggressive buying coming in here. I still see a lot of passive accumulation. And then over here, maybe somebody, would, if you start to see a lot of buying imbalances in here, people will say, well, yeah, how could you not buy that? And then look, you get rewarded here. I would not want to stand in front of this period right in here. So, for me, if it was capitulation, I'd be looking for a stronger delta there. This one, people say, well, 11 o'clock, it gives you 2 hours before the Fed announcement to trade. Well, okay, but I know that the volume is going to be lesser. You can see how at some point it's going to dry up. You can see here at the last hour how the volume is. Here you're trading anywhere between, here's 9,000 to 27,000. Then in here you can't even get above 8,000 contracts in here. So everyone is at this mode of just wait. So don't get there's certain days of the trading calendar to stay away from. Now price exhaustion reversal. Let me drink something first. Occurs when there's declining volume or delta going into a higher low. At a high, buying is decreasing or drying up. Prices simply become too high and buyers no longer interested in getting long, as the capacity for a further move up is extremely limited. At a low, sellers are exhausted. No one is interested in selling so cheap. As the opportunity for prices to drop further are limited, there will be no chance to cover the shorts at lower prices. Conversely, at a high, traders holding supply are not yet ready to start offering the supply because they're not yet convinced it's high enough. At a low, demand is not yet built up enough for traders to come in and start being aggressive. This is a reversal trade setup depending on existing price trend. So, what does it look like? You're looking for the reversal. Now, the first low you have here, would you consider this the exhaustion? No, I mean, look at it. Traders aren't getting exhausted yet. They're still selling massive amounts. The selling is getting stronger. 300, 2889, 3054 in the delta. Okay, you make the new low. Here, you got strong delta, right? That's not what you're looking for. What you should be looking for is this low here. It's coming into new lows. Volume is, the delta is 1500. Then it's only 700 and starts reversing. You do have a nice point of control towards the bottom. I don't have the POC trader turned on, but I know that is a prominent point of control. And then you see the delta switch is positive 2000. That's a good sign in there of potential low here. I would not consider these lows because you happen these lows on the strong negative delta. What I'm looking for is the deltas to get weaker coming into the low, not stronger. Now this one failed, right? It started out okay. You're coming up into this high here, right? You got your deltas contracting 1700, 1500, 300. Then you got the big strong negative delta 1100. Here it's still a strong negative delta, even though it's weaker, but it's still strong 700. And then you just come right back with the last big gasp of buying in here. Positive delta 2000, positive 1100. Selling comes in. This one is, this is, what drives people nuts in the markets is you get, your sell signal and then you just poke up, then you come down and they're right. Imagine you're short in here at 63, but you get stopped out up here at, 64 and a half. Then it goes down to 59. So, the operation was a success, but the patient died. Okay, so now granted, you're looking at delta here, okay, not necessarily the volumes, because this is right when the cash opened, but the deltas are going to get bigger once the cash open. So cash opens, and you see the delta is positive 2,600. Then you get the inside bar, so I'm not really concerned with what's happened here. I'm really concerned with from here over, and you don't get the follow through big buying. You're a little bit lower here, and next bar minus 700, then next bar minus 5,000. So where's the, you're going from big positive delta to small delta to negative delta to big negative delta, and you can see as you just go lower. Where does this market trade back to? Trades back to this point of control here of the big bar down, right? The big selling bar. That's where your resistance was in the bar, and that's where you trade back up to before continuing on down lower. Here we go. Now again, as you're coming down here, people say, well, what about this low here, right? You got minus 1500, minus 748, positive 927 with the red bar. It's telling you got positive delta. But if what I was talking about earlier, look at how the bar is forming and what's happening. Why do you got positive delta on this red bar? It's because you have offers up in here, 1600, 1046, 1081. So people were buying this. Again, this point of control setup is a very bearish setup right in here with the higher point of control on a red bar than the previous bar. So don't get too caught up in thinking, oh, we're starting to rally. Look, we got that positive delta. When you look at the bar, it takes you 2 seconds to look. Oh yeah, I know why we got that positive delta, because it's very bearish up in here. You ran up into a pocket of sellers, people with offers in the market, to push down the market, to hold the market there. And you can see how we rally back up to that level before we sell down. Then you get down in here, all right, you got 889 minus 1300, then minus 252. That's a green bar. Okay, well, that's runs the opposite of what you just learned right here, right? You got the negative delta on the green bar, so it's telling you that there's supportive buying in here. Down in here, people are selling those bids before it really turned around and started rallying back up. There was someone absorbing the selling. And then you can see the next bar, big strong positive delta, and it works its way up. This is going to give you a low risk buying opportunity in here. What should you be getting short in here? I mean, I wouldn't be looking to get long off of this bar earlier, this red bar, but I'd definitely be looking to get long off of this this green bar here with the negative delta. Can you get short in here? Yeah, of course you can. Unfortunately, it just trades right back up there and stops you out, most likely, because I'd most likely I'd have my stop right just above, a tick above that high, and then it makes that move lower, then gives you a nice bullish sign down here, and you catch that move back up. So when there's large buying by funds at the bottom of it, at the end of a downtrend, the activity often has the power to change market direction. Not always, but more often than not. Okay, so here you see how we're just selling off. Get down to that low. Look at the deltas. Getting a little bit weaker. I mean, you do have this push here, minus 700. Then you get down to minus 20, plus 70, plus 169, plus 559. The buying is coming back in here. The aggressive buying is coming back in. You get up here towards the high. Notice you get the big delta here at 1000. Then it gets small, right? 139, 76, 93, 304, 121. So at this point, it's already getting weaker. The negative deltas start appearing right before the market sells off. Now, this one here, this high, right? We're going up. We got strong positive delta, 1100, 1700, 86, kind of small, minus 459. Would I be looking for this market to start selling off? When I'm looking at the market up until this bar, yeah, honestly, I am. You come down in here, you have negative delta on the green bar. Okay, I take a step further, look at the bar. Okay, well, I know that. Why do I got negative delta? Well, there is some volume in here absorbing the selling. Okay, maybe you're not convinced, but by the time you get to this next bar, you're convinced already that this market probably has some capacity to go higher, which it does. Then you get up here. This is your next trade, right? People say, "Wow, I totally misread this. I'm gonna wait for the next trade and see if it works out." Don't. You got to be there. You got to take the next trade. So you got 679 on this push up to new highs. Make the new highs. You got positive delta on the red bar, so I know that there's some resistance selling up there near the top of this bar, most likely. Bar is red, then boom, minus 1400. Now, would I be looking to get short off this bar initially with the positive delta? I mean, you can. It's a bit aggressive, but if you wait for this bar here to confirm it, the aggressive selling is taken over. You're talking a move from 60.10 I'm not going to say down to 59.90 where you have the prominent point of control, but maybe somewhere in here, below 60. But this is your sign right here. The delta is getting weaker. You got the red bar with the positive delta, which is bearish as well. Then the big strong negative delta appearing in here before you get this little move lower. This one just went sideways on you, right? You got your big volume push, delta push up here, delta small, positive, the big negative delta, and it just sort of goes sideways. This one, I called this coming in too hot. This is, it's similar to capitulation, right? But this market it's like I said, markets sell off very fast sometimes, faster than the way they rally. It's coming down in here, boom, 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 everything's new lows, new lows, new lows, new lows. But it's getting a bit lesser. The deltas, 4,000, 2,300. Then you get the big positive delta. It just goes sideways on you. If I was long in here and I'm a half hour later and I'm still around break even, you get out. This one, I think the market was just coming down too fast, too quick, too soon. But I'd still be looking to take the trade, in here anyway. But again, after you take the trade in the market, you get long. Market comes off, comes back, just hanging around. Market's indicative of going sideways, like I said, is point of control is right or punched around the same level, which you see here. Then you get that push down again, and then it sort of comes back up. But this trade just didn't work out. Again, similar crash landing. People say, well, isn't it capitulation down in here? Well, I would consider it capitulation if these deltas were a lot stronger, 2,500. So it's a lot less than 3,000. It's very similar to this one in here. But this market drop is just too fast, for my taste. And to look at this as a reversal. Now, if you got down in here and, one of these bars off this low was littered with buying imbalances, I'd probably be looking to take the trade. But when a market drops very fast, I don't say I'm hesitant. I'm scared actually to just all of a sudden start have a reason to buy. I really need a strong reason to buy. Then then like this where the delta is minus 2,000, minus 100, plus 400. Because I find that oftentimes when it drops like that, you get the big volume, the big negative deltas. It's still might have a little bit left to it. I need more convincing to be getting long in here. And I don't like the way these bars are shaping up. This is almost a doji. This one, we opened, rallied way up, closed right down near where we opened. Even though the point of controls are bullish by itself, I really need to see the aggressive buying in here. The buying that you saw earlier is no longer there, right? Why isn't this bar closing up near the high and rather down near the low? So it's telling me it's just doesn't look good for trading opportunity. So setup number 5, absorption pullbacks. It occurs in trends when the market is moving in a particular direction, not at a new high or new low yet, but pauses for whatever reason, goes sideways before continuing in its original direction. Look for volume to pick up or delta. Volume or delta. This is a trend continuation setup, right? Everyone says you got to ride the trends, right? You got to ride the trends. Well, look for it. Okay, so here the market's going up, 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 pauses, comes back down, rallies back up. Well, what's the sign? Look at the volumes. 9,000, 10,000, 15,000, then 9,000, 8,000, 5,000, then it pops back up again. 7,992, another 7,000. So there's still room left for that move. Okay, here, so you got your high. You start selling off. You bounce a little bit here, right? The trend now is down. I'm not looking for this as a necessarily as a trend back up. I'm already establishing that this is my swing high based on things in the order flow, right? Negative deltas. This point of control is bearish here. Obviously, I got the single print here. So at this point, I've already considered it's reversing, right? So then I'm not looking to buy here for market to go back up. I'm already looking for this market to start selling off. But again, maybe you look at this chart, you see something completely opposite. You say, oh, Mike, you got to be buying there. You got a delta surge here. Well, yeah, the delta's picking up, but look at this. The highest is 113. It's not higher than any of these other previous numbers. So, if it was 1,300, I might be looking at it different. And then you get the big volume surge here, 23,000, and the market continues on down. It would look different. Like I said, if these numbers were different, 1,000, right? It's less than the volume on this move lower, 9,000. Okay, so you hit your low here, right? You got the big down bar, you got your up bar, your big volume down, decent volume back up, and it's just sort of going sideways, sideways, sideways. And people say, well, hey, you got a big volume down here, okay, but you got a big volume up here. So these these sort of wash each other out. Would I be looking for a move back down in here? It's possible, it could, but do you have really any sign that it's possible that it can? Right now, you don't. Right? You don't really get a sign to be getting long that this market is starting to rally till about here, right? There's not a lot of buying imbalances in here. You're looking at this, the market is sort of going higher, green bar, negative delta, negative delta. What's it telling you? There's supportive buying in here, supportive buying in here. Point of control's higher, which is also bullish. When you start stringing together point of controls going higher, obviously that's, value in the bar is moving higher as the bars move higher. It's a bullish sign. Then you get your big positive delta here. You're getting in this bar ideally at 58.70, and it's got to move up to, above $59. But again, there's not much information in here. The market's just going sideways. There's not much till you start seeing it in here with these deltas, with the green bars telling you the support of buying. But really, I wouldn't be looking to get long, a strong confirmation until this bar here. Now, again, sometimes I put this chart on here because oftentimes, people like to look for stuff that probably isn't there yet. Would you consider this a pullback? This market's going sideways. Okay, you're going to consider this a pullback, or you can consider this a pullback? I wouldn't consider either of these at this point. For me, the market hasn't established any trend in any direction, right? If you're looking for a pullback, you should have established a trend, and it's just nothing. There's just nothing happening. People say, oh yeah, I'm going to try and, I think there's a pullback here, or I think there's a pullback here. Well, you're in a very tight range. There's not an existing trend to get excited about to look for a pullback. Now, this is here you have established trend, right? We're going lower, rally back up. Would I consider this a trend or not? Well, I'd be looking, I'd be more concerned with getting long here than getting short. I wouldn't be considering this a pullback at this point, because in my mind, I'd already be thinking, I want to be long, and I would miss the trade. That's what makes trading so unique, is that people could look at a chart and have two different outlooks. I wish I could say, well, yeah, I shifted my idea to all of a sudden think that this is a pullback to get short. If I was long in here, which I would be more inclined to be long than looking for a pullback in here, I'd be like, hey, this is my low. I'm going to be buying in here. I got the signs that the market's going higher. There's very bullish signs in here. You get to this inside bar. Now, again, inside bars, you got to be careful with, because, it often might trigger, some sideways activity, or potential reversal, or obviously it could be continuation. When you get down into this bar here with the big volume, 15,000, that already, that's the sign. If you were still long by that, this bar would stop you out right here. But even that, I still wouldn't be looking to be getting short off of this bar, Instead, I'd be, as this market's moving, I'm looking at this bar, I'd be wanting to get long already. You got your ratio, bullish ratios on the way up. And, sometimes you're sort of caught in a trade already that of one type, right? This is, for me, this is a very bullish setup that I'm not necessarily looking at this point like, oh, this is a short setup here. I'd be stopped out, even though, when you start looking at this, then I say, okay, yeah, that's probably a pullback. We're in a downtrend. I tried to buy it. I'm wrong. You get that big volume here, but I wouldn't be looking in here as this a pullback being set up, not until this bar comes in. But once this bar comes in, I might be considering to get short, but really I'm so hypnotized by this initially that I'd be looking to get long, and I would take the losing trade here and get stopped out here. Now, this is that Fed day again, right? I showed you that earlier. Your pullbacks, right? You hit your high. Honestly, Fed days are days I don't participate in the market. It's just not. It's just too much volatility. I mean, you get fantastic moves, and some people say, "Well, how could you not?" There's so much moves. It's like, the way I describe it is like trying to pick fruit on the tree, right? There's so much low-hanging fruit oftentimes. Just go for that. Don't try to pick the one way out, even though it's a beautiful apple sitting out way at the end of a branch. Don't try and climb out there and get it, because oftentimes you'll fall. But you got your divergence, you got your prominent point of control, market's selling off. Comes back up a little bit here, and then you get slammed on this bar. Would you be looking to trade a pullback here? I'm not that convinced yet, but you get that big volume down in here to make it look nice. Again, sometimes people try to look at these things and say, well, yeah, you got this little bit of a pullback. Nah, they try to justify this move here. Like, yeah, how could I have caught that move? Well, I got this little bit of a pullback here. Not really. There's nothing in this volume to tell you that. Okay, so you have your downtrend established. You got your big up bar, but then you get your bearish bar here. Okay, now again, when I say it's borderline, what I mean is, sometimes you don't want things clouding, your trade idea, right? Because you got your big sell-off, you start rallying back up, but you have this bullish bar here, so. When you're long, right, you're not looking for that pullback of the move down to continue on down lower, right? You're looking for reasons to be getting short. Now, you get back up here, right? You got the big strong negative delta. It's bearish in that sense. This one is decent volume, 26,000. Obviously, it's not your 50,000s in here. It's a bit less, but relative to the previous two bars, it's still a bit strong. I'd prefer it to be a stronger volume. The delta is all right, but I'd prefer it to be stronger volume. 26,000 is still a bit less than what it was earlier. That's why I have it as borderline. Again, I'm not really necessarily looking for a pullback at this point. Now, I say borderline, or is this a pullback here, right? You got your big move down and going sideways. You start going up, then you got the sideways activity. Again, people like to say, well, you got this pullback here. No, this is just market going sideways. All right, the volume is lesser, 18,000, 17,000, 24,000. It's small volume relative to what it was earlier. Here you're in the 30s. Here you're in the mid 25s, and all of a sudden you're trading 18,000, 17,000. Then it starts increasing. I would not consider that a pullback, not at all. And I'd want a lower low. in here. If I was looking for this market to be going up, if I was to be looking for this market to continue on down, obviously I'd want to see negative deltas in here and a strong volume red bar, right, for this market to continue on down. You know, it's one thing to look at a market and say, well, yeah, you know, like now, right, you're looking at this chart and the market went up, right? You can say, well, yeah, it's possibly a pullback. But when you put your hand over this right hand side here and the market sold off, bounced up again, it could very easily, instead of going up like this, have gone down. But what's the signs, right? Instead, you're seeing all the positive deltas. That's why I'm not even thinking that this is a pullback to go lower, right? Because we're just overwhelmed with, you know, the positive deltas in there. Now, I touched upon this earlier, but I just want to point this out. Now, be careful, right? When you're trying to analyze volumes around cash open and cash close, that's the time when you have the most volume, like here, right? 3 o'clock, 1500 hours, 3 p.m. Chicago time is when the futures cash close is, right? The actual cash market closes at 3 p.m. Chicago time, but the futures still trade. So that's when you're going to see a big volume spike, 57,000. And sometimes you see it occurring a few bars prior, not always. But don't say, oh my God, we have 50,000 contracts traded. There must be something. Well, it's the cash close. That's why. Okay, so try to avoid getting caught up in that cash close number. All right, so the last setup is the absorption breakouts. Now, it's similar to a dead cat bounce and inverted dead cat bounce setup, but the difference being that an absorption breakout doesn't need to occur immediately after a new high or low. Similar to accumulation distribution, occurs when the market has been moving sideways and coming out of a narrow range. This is a trend setup, right? So what's happening is you're breaking out and you're expecting the market to continue in that direction. The problem with breakouts is knowing when the breakout ends. Okay, it can break out a few ticks or it can break out a few hundred ticks. And that's the problem. You know, I used to be a big breakout trader in my early days when I first got started. You know, I would buy breakout and think the market's going to go to infinity, basically. And oftentimes it doesn't. You know, it can continue 5 ticks, 10 ticks, 20 ticks, 100 ticks. And unfortunately, it doesn't always go on forever. It's going to eventually stop. But still, breakouts do provide great trading opportunities. So what you're going to look for is at highs, you're going to look for aggressive buying, you know, imbalances ideally, and passive buying following. So and what that means is, you know, people are lifting the offer and turning the market bid, supporting the market as you're taking out those highs. At lows, look for aggressive selling, and then the passive selling following. What I mean is people hitting the bid, you know, ideally if you can see some imbalances, great. If not, it's not the end of the world. But then what you want to see is the offers, big size offers holding the market down to, you know, put a cap on people trying to buy the market to move it back up. So, you know, on the chart, this is how it is, right? So you take out the high, you got your buying imbalances in here, great. But then you notice it's followed up with big bids here, 1,000, 1,600, 1,000, 1,100, right? Normally, you're not really seeing big volumes like that. I mean, you see some in here, 1,800, 1,500. This is a market that's going higher. It's already exhibiting the supportive buying on this way up. You know, even in here, you're seeing some big volumes in here. This is a 4,000, this is 1,800. And you're going to see, you know, positive deltas. That's what you want to see, right? You want to see the follow through buying in forms of bids, you know, supporting that market, right? That's your sign that this market can go higher, right? Because if you have bids, who's bidding big sizes, the big players, right? Not the retail traders. Retail traders were making new highs. They start getting excited. They start lifting the offers. But like, you know, normal moves, right? You're seeing volumes in the 600s, 800s, 500s, 900s. All of a sudden you're seeing big supportive buying 1,000, 1,500, 1,800, 1,000, 1,600, 1,000, 1,100. That's telling you that there's people supporting this move, you know, longer term traders supporting this move. Here, you're taking out this high. Look at the volumes, 2,500, 2,000, 3,000, 2,000, 1,500, 1,900, 2,000, right? Normally, you're seeing volumes in the 900s, 1,000 would be considered big. But as you're taking out this high, you have the aggressive buyers following through, the big passive buyers following through in the market. Here, you don't have the imbalances that you have here in this chart, but you still have that passive buying supporting that market on the move higher. Here, all right, you got new highs. This green line is the high. You got the aggressive buying, the imbalances, and then look at the bid size. 200, 75, 200, 392, 246, 208. So you get some supportive buying coming in here, following the market, the hold up market. Point of control here at the high, the bar, point of control here as the market moves up, up, up. Now on the move down, right? Obviously, you've seen this chart before. I've told you about this ratio and divergence. But take a look on this move here, right? What are you seeing? Look at that right here. That volume. To me, this is the giveaway here. This 1037. Even in this bar, 1358, 1102. Even here 1155, even up here at the high, you got some decent volume. When I start seeing heavy volume, it's like this, sort of concentrated at the tops of these bars, right? I already decided we're going lower, right? I got my ratio divergence. Then when I'm looking at the top corners of these bars and I see some nice chunky volume, that's telling me there's offers in the market. That's why these bars don't go higher. It's because there's offers here. There's sellers in here. Doesn't necessarily mean they have everything showing in the order book. No, the people, they like to reload, right? They let the market, they're selling it down, let the market breathe a little bit, sell some more, let the market breathe a little bit, sell some more, and then whap, it just gets slammed. Now, here you got your breakouts go lower, but you're not necessarily seeing these resistant selling. You're seeing big passive buying. You're seeing signs of accumulation, right? You get up here. This is not really the breakout anymore, right? You should be seeing this volume down in here, right? This is the problem with breakout trading. Yeah, breakout trading, it broke out. Well, technically you broke out. Yeah, it worked, but you only broke out a few ticks. And instead of seeing the resistance selling, what you're seeing is a lot of passive buying and off those lows. So not a good sign. Here, right, you're breaking out. Now notice this bar here, right? You broke out these new lows. You got a lot of volume in here relative in this bar, right? Up in here, right? Everyone is more interested in selling. Now you do run into some passive buying in here, okay? This one, again, this is the problem with breakout trading, okay? You break out, very aggressive selling going on in here. It's almost, like a stop got triggered or something got triggered in here. You met this passive buying, market rallied back up. Where did it rally back up to? It rallied back up to this area where you did have some resistance, okay? Then you slam back down. This is not what I like to see on a breakout bar like this. I'd much rather see stack selling imbalances coming in down here, not up here. You just run down in here with more volume to absorb all the selling that's going on. So again, don't get too excited. Sometimes, we're breaking out. Look at all these stacked imbalances. You got to watch what's happening. Are you coming into an area of support or not? And then where's the follow through selling in here, right? You have this void, all these zeros, right? That's why I say it's probably like a stop got triggered and just knocked everything out. And then it came back in and filled that void, right? What you should be seeing, if this market was truly going to be selling off immediately to much lower lows, you should be seeing the zeros and then heavy offers in here. Heavy offers as the market's going down. And you're not seeing it. You're seeing it more on the bid side than the offer side. Okay, this one, it's a little hard to see. Some of these charts are scrunch. I've been trying to readjust the font size, but as you're taking out these highs, what you're looking for is sort of like this step, so to speak. This is what people call steps. But when in the steps, look at the volumes here, right? You got 4 figures, 1,000, 1,200. Over here you got very small volumes, 900, 800, 100, 500. Here you got 1,700, 1,500, 1,000. I'm always looking at the volumes on the bid side as you take out these highs. Is it stronger than what the volumes were on the bid side earlier? Okay, here, 1,100, 1,600, 1,600, 1,500. Because that's your bidding, right? That's the bids, what's traded on the bid. So I know that there's some strong bids in here, some strong bids in here, strong bids in here. That's going to be sort of what's forming your steps to go higher. You should already be long, right? At the latest, you should be getting long in this bar up here at 46. Now you do have a ratio and divergence. Market goes sideways. It's interesting because this is the only positive delta in this whole move up, or sorry, the only negative delta in this whole move up. But really the signs were earlier here, 9 o'clock here, 9:10. You got your big pocket of supportive buying, another pocket of supportive buying, another pocket of supportive buying here. So you got 1, 2, 3 already before you get to this big jump up. Here you got your breakout, breakdown rather, making the new lows. I like that you got the heavy volume here. I like that you got your heavy volume here. You break out, you make the new lows. Unfortunately, it only goes down to 42.25 before it rallies back up. Again, this is the problem that breakout traders face, is you get your breakout, but it's not juicy enough. That's why, over time, I've become more of a reversal trader. I think reversals offer bigger capacities than breakouts, but that's just how I feel on it. Now, would you consider this a breakout? No. Where's your supportive buying in here? You don't necessarily have it. Even up in here, you don't really have big supportive buying. Like here, 1,800, 1,300, 1,000. But even up in here, you're not really getting it. Here, you get 2,000. Get your ratio divergence. Already, market sells off. Again, this is not the type of breakout that I'd be looking for, because you don't have the supportive buying. There's nothing over 1,000 up in here. Again, very similar. It's a breakout. Technically, it made a new high, but this is not what I'd be looking for. Where's your absorption in here? Where's your absorption buying in here? Yeah, we'll say, well, it's decent. It's 300, 300, 300, 351. Yeah, but look at these regular bars. You're getting 400, 600, 500, 600, 600, 200. It's not standing out. It's not standing out. And here, right, it went sideways. It's a breakout, but why did it go sideways? Well, first you got your inside bar, but look at the volumes in here: 1,200, 600, 300, 750. Where's your big absorptive selling, right? Your big resistance selling here. You got 700, 1,000, 700. At the area where the point of control is, are you seeing the big volumes to sort of keep it lower here? 500, 600. You can't. You got this little light volume, 682. Right? It's not. You should be filling this in with heavy volume, and you're not. Then you start going sideways. Again, I've talked about this. Sideways activity is usually indicative with the inside bar. So you gotta put these things together and understand what's happening in the market. This is what used to kill me as a breakout trader. And granted, when I was a breakout trader, my knowledge of markets was much less. But yeah, you get your breakout, and then it just go a couple ticks and do nothing. Then come back and stop you out. Now again, this is why I like looking at a delta chart, is because sometimes you see things just really stand out. Like here, right? This is a very bearish bar, all hitting the bids. You got the big offer there, even a little bit earlier, hitting these bids. You got a decent size offer here, 126. Again, that's not what the actual volume is. This is the delta, the difference between the volume on the bid and the offer. But when I see big, it's what I call a delta bulge. When I see big bulges like this, it's telling me that there's resistance in the market here. But by this bar, I should already be short. So at least I could capture something. So like I said, you're trying to trade the breakout, you get short. Does it break out? Yeah, it goes down from 65 down to 45. Not necessarily the greatest trade, but still, notice where the market comes back to. It comes back to these areas where the bulges are, right? Comes back. This one comes back to this bulge here. This one comes back to this bulge here. You got your breakout here. But you're running into supportive buying, right? Where is your strong offers in this bar, in this bar, in this bar? You do have some here, 131, 73, 84. Mostly transacting on the bid side, but then it just goes sideways. Yeah, it breaks down 05. So there is some capacity for this trade, but again, it's not the greatest trade. Again, I wouldn't be getting short and then holding it through here to get down to here. Really, I'm looking for, with the breakout, right? You're looking for the market to just fall over, right? Not go sideways from 7:30 to 9 o'clock. But again, if you're short somewhere in here, yeah, when you start getting back up in here, this is the worst feeling. You're short at, you get short at 7:20, 7:25. 8 o'clock, you're still in the position, and it's sort of going against you. Even though this is kind of bearish looking, you do have some resistance up in here. You can see with these deltas that there's some selling going on up there, passive selling, before the market sells off. But you're trying to trade a breakout. You're looking for that breakout to just drop like a rock. All right, so this is the last chart here, I think. Strong offers traded at high indicate supply explains why the high was short-lived, right? So you hit your high. These are trap traders up in here, right? All these guys buying this high, thinking the market's going higher, right? This is what you talk about when people say trap traders. Now, I do like that you have this supportive buying in here, and this is the problem with breakouts, right? Is you run into these areas where the breakout just ends, right? All these people, they're buying it here. They're all excited. They're buying it. Bidding. 272. That's your highest volume in the delta anywhere in here. I think, there's 246, there's 243, well, there's 278, but 272 on the offer side. So you got a lot of aggressive buying going on up in here. Why isn't it carrying the market higher? These are the questions that you should be asking, as a trader. Look at the deltas. It's getting weaker. 616, 536, 313 turns negative 200. Okay, that's not a bullish sign anymore. Even though you can say, well, you got smaller deltas indicating supportive buying. Okay, yeah, I understand that. You have this aggressive buying here. Where's the follow through? This bar price action, it's closing down. Not down, but it's closing lower than where you were earlier, right? It's still a green bar, but it's still well below the high that you were at earlier, right? You need that follow through. You want to see it. And then if you don't get it in this bar, fine. Look for the next bar. Are you coming up near the high? No, you're still well below the point of control. And then you start looking at this bar here. You're seeing negative delta. So you're seeing the supply delta, 135, 165. You're looking in this bar, 141. It's all on the offer side. Even in here, this one's being offered down. Look at that, 26, 22, 100, 129. People are hitting this bid before the market sells off. All right, so this one, it's not a trade setup, but I just put this in there. This is an old market delta thing that I've always had in my mind. Trevor came up with this years ago. Point of control in the top 33% of the bar's range and positive delta indicates buyers buying at higher levels. What's important to watch is what happens next. Does it continue in the next? Right? Point of control, top 33%, positive delta. Right? Well, what's happening next? Right? That's not a good sign. Right? Usually you'd want a higher bar. Right? Are you taking out this high? Like here, point of control, top 33%. Point of control, top 33%. Next bar is up. That's good. Next bar, well, it's a little higher. Next bar is up. Okay. Point of control on the top, no, it's lower. It's going sideways. Point of control, top 33%, but we're well below that now. That's not a good sign, right? But I put that in there because that's something to when you're assessing point of controls and deltas. Watch that, right, for trends. That would be bullish. Okay, this one is bullish. For a bearish sign, obviously you'd be in the top 33%. Next bar would be below the point of control in a red candle. But flip it over for a market selling off, right? Point of control in the bottom 33% with negative delta means sellers in control. So just a few things to highlight, right? When sellers aggressively step in to supply the market at an unrealistic high, the market tends to drop back and return to the value area as its first target area. Now, stop placements. People always wonder, well, where do I place my stop? Well, you place your stop where the reason for the trade is invalid. If you get into a trade because it's exuberance or capitulation, your stop should just go just below the high or low of the move. If you get into a trade because the market is consolidating, you're trading a reversal, place your stop just above the recent high or low. If you get into a trade because the market's consolidating, you're trading a breakout continuation, place your stop just above the recent high or low. Now, the hard part of being a trader is deciding to get out of position when you reach what you think is an area of absorption. The tendency should be to get out, but long-term traders are not always right. Don't think that just because someone's a long-term trader, they're automatically 100% right. No, long-term traders have losing trades as well. The market can continue in its original move, right? Just because a long-term trader is long doesn't necessarily mean that the market's got to keep going up. Just remember, at that point, you can always get back into a position if needed. You could just have been a long-term trader taking profits. You won't know if it's a high or low until some time has passed. Unfortunately, you're not going to know a high is made until the next bar is formed, confirming that that's the high. You take a position at a high saying, I think this is the high, and we get short. Okay, well, you're not going to know until the market starts moving, right? Period. Sometimes people lose sight of that. That's why I put that in, even though it doesn't really. People say, "What?" Of course you're not going to know until time has passed. But again, sometimes people they don't know. They get a little excited. That's why I always say, wait for bars to close for confirmation. All right, so this was a long module, but hopefully you got a few golden nuggets out of it. So this concludes Module 6. In Module 7, I'm going to show you how to put it all together, help you become a better trader. So I'll see you on the next module. Bye-bye.